Welcome back to Iron Financial. This is the explainer where we take the market's raw, unfiltered financial data, throw it right in the furnace, put it under extreme pressure, and help you forge a significantly stronger, totally resilient portfolio. I am your lead analyst, and my mission today is incredibly simple. We are going to cut straight through the current market weakness, strip away all the noisy, panicky headlines, and look directly at the bare metal of a massive corporate balance sheet. Today, we are actively stress testing an absolute titan in the energy sector. We're talking about Canadian Natural Resources Limited, ticker symbol CNQ.
Right, and I'm the Market Skeptic. I'm here to represent you, the listener. Because look, whenever I see these massive, heavily capitalized energy conglomerates, my very first instinct is always to ask the really hard questions. Is this actual, real, sustainable operational growth, or is it just cyclical commodity hype riding on the coattails of higher global oil prices? Are we actually standing on a solid foundation here, or are we about to find some serious structural cracks in the armor?
Well, that is exactly what we are going to drill down into right now. We are putting their Q1 2026 earnings squarely under the microscope. We're going to analyze their aggressive new cash flow tiers, and we are literally tearing down their production mechanics to see what is really driving the machine under the hood. So let's get to work. Let's start right at the top, looking at the headline numbers. Because for the first quarter of 2026, Canadian Natural Resources laid down a massive foundational profit of $1.35 billion. That is a huge, heavy chunk of absolute bottom-line profit generated in just 3 months of operation.
Okay, hold on a second, though. I am looking right now at the year-over-year comparables. And if you go back to the exact same quarter last year, they posted $2.46 billion in profit. So just mathematically speaking, we are talking about a very significant drop in net earnings. Is $1.35 billion really enough heavy lifting to cut through the insane volatility we are seeing right now in the broader markets? Or is this massive machinery actually starting to slow down, rust a little bit, and lose steam?
See, that right there. That is the exact value trap that novice retail investors fall into every single day of the week. You simply cannot just look at raw, unadjusted profit in a highly cyclical commodity industry and call it a day. You have to look at how the underlying operating machine is actually functioning on the ground, in the dirt. To understand the real structural integrity of the business, we have to completely look past those top-level macro fluctuations and examine the adjusted earnings. Because when you aggressively drill into those adjusted numbers, a completely different, much stronger picture emerges. Wall Street and Bay Street analysts estimated that Canadian Natural would bring in an adjusted earnings per share of $1.07 Canadian. The actual result, $1.17 per diluted share. By intelligently stripping out the noise of fluctuating global commodity benchmarks and weird one-time accounting charges, we can finally see the real engine at work here. Market Skeptic. Okay, fair enough. So that's a solid 10-cent beat. That is essentially a 10% outperformance against what the consensus expectations were. But what does an adjusted EPS beat actually represent for the everyday investor who's just holding the stock in their portfolio? It represents their financial armor. Honestly, it's that simple. On a strictly adjusted basis, they actually beat last year's Q1 earnings, which were sitting at $1.16 per share. This means that despite whatever wild volatility is happening out there in the broader crude oil and natural gas markets, CNQ's day-to-day operational execution was so ruthlessly efficient that they squeezed more adjusted profit out of every single share than anyone modeled for. They are effectively shattering the stress tests built by the market's top analysts. Well, let me interrupt you right there, because I want to look really closely at the top line for a minute. Product sales. The actual incoming revenue. It visibly dropped to $12.4 billion from $12.71 billion a year earlier. You keep praising their financial armor, but their top-line revenue is literally bleeding. How can you confidently sit there and claim they have structural growth if they are physically bringing in fewer total dollars from their sales? I need absolute clarity on the actual physical volumes coming out of the ground. Are they actually growing the business, or are they just aggressively managing their profit margins while their output declines?
That is absolutely the perfect question to ask, and it perfectly highlights the critical difference between price and volume. Listen, revenue naturally fluctuates with the daily, sometimes hourly price of oil and gas. You can have your total revenue drop simply because the global commodity price ticked down by a few bucks, even if your underlying company is physically stronger, drilling way faster, and producing way more. To find the objective truth here, we have to look entirely past the dollar signs flashing on the screen and look directly at the physical barrels.
This is exactly where the undeniable structural volume growth reveals itself in the hard metrics. Total physical production averaged 1.64 million barrels of oil equivalent per day. That is a clear, hard, undeniable 3.8% increase year over year. Oh, okay. So the physical machinery is indeed pushing out more total volume. And wow, look at that natural gas figure specifically. That's up 8.9% year over year to 2,670 million cubic feet per day. That is some serious, substantial growth. Exactly. It's massive. And their liquids production, so we're talking crude oil and natural gas liquids, that was up 2.1% to 1.20 million barrels per day. The underlying machinery is literally firing on all cylinders. They are physically extracting more product across the entire board. That slight drop in top-line revenue you brought up earlier, purely a function of global pricing mechanics. It was not an operational failure on their part at all. Their actual physical production muscle is literally growing stronger quarter after quarter. Now, pay incredibly close attention to this next point, because here is arguably the most critical number in this entire explainer. $23.73. That is their operating cost per barrel for synthetic crude oil, or SCO, measured in Canadian dollars. When you convert that over in US dollars, that operating cost is sitting at an astonishingly low $17.30 per barrel.
Wait, seriously? Are you telling me it only costs them $17 US to fully pull, process, and completely upgrade a barrel of synthetic crude? That sounds incredibly, almost impossibly low for heavy oil operations.
Yes, it is, but it's real. This is absolute, undisputed, industry-leading efficiency, and it forms a massive economic moat around the company. Think about where oil typically trades, right? $60, $70, sometimes $80 a barrel. When your baseline operating cost is sitting all the way down in the basement at $17, your profit margin is a literal fortress. This low-cost, long-life, low-decline asset base is CNQ's ultimate defensive armor. It means that even if the global economy completely crashes and oil prices plummet to the floor, CNQ can still maintain a rock-solid balance sheet and churn out cash, while their higher-cost competitors are literally bleeding out and just fighting for basic survival. And by the way, this incredible operational efficiency, it is not just some localized, lucky first-quarter phenomenon. Look at the fresh post-quarter data we have coming out of April 2026. Their world-class oil sands mining and upgrading assets achieved a staggering upgrader utilization rate of 106%.
106%, so they are actively operating above the official nameplate capacity of the facility. They are literally redlining the heavy machinery past its supposed physical limits.
Exactly. And to fully understand why this matters so much, you have to know what an upgrader actually does. They are taking raw, heavy bitumen, which typically trades at a massive, steep discount, and they are upgrading it into premium synthetic crude, pushing the machinery past its limits to do it at scale. They pumped out 630,000 barrels per day in April alone. And here is the absolute kicker. This synthetic crude oil trades at a premium to WTI. It's averaging a $5.70 US per barrel premium on the forward strip for the rest of 2026. So they are producing at maximum stress test levels, doing it at an incredibly low cost, and selling a vastly superior product at a premium price. The foundation isn't just solid, it's practically vibrating with efficiency right now. All right. I will concede the point on the operations. The operations are completely dialed in and highly efficient. I get it. But let's look at the broader macro picture for a second. This is a highly capital-intensive, notoriously cyclical industry. The biggest threat to massive energy companies isn't always the oil remaining in the ground. It's usually the crushing debt they carry around on their balance sheet. And CNQ recently acquired major assets from Chevron, which definitely added significant weight to their obligations. I need to see the exact blueprint for how they are allocating their incoming cash. Are they hoarding it out of fear to pay down dangerous debt levels, or are they actually tangibly rewarding their shareholders?
And that is the exact right way to stress test this thesis. Because to understand their current financial horsepower, you have to completely understand the highly disciplined chronological evolution of their capital return framework. They don't just sit around and guess quarter to quarter. They follow a strict, mathematically formulaic blueprint.
So let's map out that history really quickly so it all makes sense. Before October 2024, they were returning a massive 100% of their free cash flow directly to shareholders. It was a fully activated cash machine. But then they announced the massive Chevron acquisition. To digest a purchase of that extreme scale intelligently and, more importantly, safely, they executed a strategic pivot. They committed 60% of free cash flow to shareholders and diverted 40% back to the balance sheet to aggressively pay down the new debt they just took on.
Well, yeah, that makes total logical sense. You buy a massive new asset, you secure the perimeter by immediately paying down the newly acquired debt so you don't over-leverage yourself and end up in trouble. but we are well into 2026 now. Have they actually paid it down enough to shift that balance back in favor of the everyday investor?
Yes, they absolutely have. And that brings us directly to the March 2026 update, which is where the aggressive new payout tiers were fully initiated. They successfully stress-tested their own acquisition debt, paid it down, and are coming out the other side stronger. So here is the absolute ironclad blueprint for 2026. If net debt is sitting anywhere above $16 billion, 60% of free cash goes to shareholders and 40% goes to fortifying the balance sheet. But here is the absolutely crucial pivot point. Because of their incredibly strong netbacks, their net debt has actually dropped below $16 billion. They have officially triggered the middle tier.
Okay, so that means they've crossed the threshold. Right now, as we speak, any free cash flow they generate is being mathematically split, a massive 75% going to direct shareholder returns and only 25% needed to maintain the balance sheet.
Exactly. The 75% shareholder return tier is fully activated right now. And I really want you to notice that bottom tier. When they grind that net down below $13 billion, 100% of their free cash flow goes directly back to the shareholders. They are systematically and aggressively eliminating their debt for the absolute sole purpose of maximizing your final payout. All right, let's look at the actual cash generated to fund these tiers, because honestly, the corporate accounting terminology can get really confusing. I see here that adjusted funds flow was a massive $4.37 billion. But then, right below it, free cash flow is listed at just $875 million. For the novice investor out there trying to build a resilient portfolio, why is there such a huge multi-billion-dollar gap between the funds they generated and the quote-unquote free cash flow?
Well, that is because free cash flow for CNQ is calculated after all the really heavy lifting is already done. It is calculated only after they have already paid out their massive base capital expenditures to keep the machinery physically running, and crucially, after they have already paid their massive base dividend. So that $4.37 billion in adjusted funds flow, that proves the sheer financial horsepower of the core business. That $875 million in free cash flow, that is purely the excess capital left over after they've fully maintained the fortress and already paid the rent to their investors.
And speaking of paying the rent to investors, let's talk about the sheer scale of that base dividend. In Q1 alone, Canadian Natural paid out an astonishing $1.2 billion in dividends directly to its shareholders.
$1.2 billion in a single 3-month quarter. I mean, that is some serious heavy lifting. But again, anyone can pay a fat dividend when oil prices are decent and the macro environment is cooperating nicely. What happens during a structural bear market when everything is just collapsing around them?
You look directly at the historical track record. In March 2026, the board of directors confidently increased the quarterly dividend yet again, bringing the annualized payout to $2.50 per share. That marks 26 consecutive years of unbroken dividend increases. We're talking through the brutal 2008 financial crisis, through the devastating 2014 oil crash, through the unprecedented 2020 pandemic lockdowns. 26 years without a single crack in the armor. And let me be clear, it's not just some token penny increase every year just to keep this streak alive on paper. Over those 26 consecutive years, the compound annual growth rate, or CAGR, of that dividend is an incredible 20%.
Wait, 20% compound growth every single year for over a quarter of a century? That is actually wild. That means this isn't just a standard, boring income stock meant to sit quietly in some retiree's account. The payout itself actually acts like a highly aggressive growth asset.
Exactly. To put that into perspective, at a 20% compound annual growth rate, a dividend payout mathematically doubles roughly every 3.5 years. You do not achieve that by accident. You build that with iron discipline. It perfectly demonstrates the absolute sustainability of their business model and the massive unshakable advantage of their low-decline oil sands reserves. Okay, but we talked heavily about that 75% free cash flow tier. Besides the reliable dividend, are they actually executing on share buybacks? Because, let's be real, a lot of corporate management teams talk a huge game about buybacks, but they never actually step into the open market to reduce the share count when push comes to shove.
They are executing aggressively right now as we speak. With net debt successfully moving below that $16 billion mark, the pace of repurchases has visibly accelerated. In April 26 alone, just one single month of trading, mind you, they repurchased $309 million worth of their own shares. They are actively shrinking the float, which means every single remaining share you own in your portfolio represents a steadily larger, more concentrated piece of that massive profit pie. They are marching steadily and relentlessly toward that $13 billion debt floor, where those buybacks will literally shift into absolute overdrive.
Now, to keep all of this massive infrastructure running, we have to stress test what they're actually spending. The 2026 operating capital budget is officially locked in at approximately $6.3 billion.
$6.3 billion objectively sounds like a massive amount of capital going out the door. Is there a genuine risk here that they are completely over-leveraging themselves just to basically tread water and maintain their current base production?
Actually, when you put it into the proper context of an energy giant operating at this global scale, this is incredibly disciplined, incredibly low-maintenance capital. That $6.3 billion is perfectly and mathematically calculated to deliver a highly targeted average production of 1.59 to 1.65 million barrels of oil equivalent per day. It strictly ensures the heavy machinery keeps running at peak baseline efficiency without an ounce of corporate bloat. Furthermore, they are also commencing vital front-end engineering work for medium and long-term growth opportunities right now, ensuring their massive pipeline of value never ever dries up. And let me tell you, that pipeline is deep. Before we render our final verdict today, we need to briefly step back and just remind everyone of the sheer scale and immense durability of this entity. We are looking at a sprawling enterprise with an approximate $140 billion market cap.
And they are sitting on roughly 15.9 billion barrels of oil equivalent in proved reserves.
Right. That specific metric makes them the single largest reserves holder in all of Canada and the second largest among their global peers anywhere in the entire world. With 27 million net acres, almost half of which remains completely undeveloped today, they possess the absolute deepest inventory runway for future value creation in the country. Listen, this isn't some flash-in-the-pan shale driller that will tap out and go bankrupt in 5 years. This is a multi-decade financial fortress. I hear your bullishness, Lead Analyst. I really do. But as the skeptic, I can't just take your internal modeling for it. I have to bring in some outside validation to truly stress test your thesis. Let's look at external institutional sentiment. Pulling up the Smart Karma data, they have an overall SMART score of 3.6, which is definitely solid, bolstered by above-average scores in dividends, value, and overall resilience. But the real standout metric I'm seeing here is that momentum score, sitting at a perfect 5 out of 5.
Exactly. That momentum score of 5 objectively proves that the broader institutional market is fully waking up to the exact financial realities we just discussed. And when you look at the analyst ratings, 10 buys, 10 holds, and only 2 sells, the overall consensus clearly understands that the powerful combination of physical production growth and rapid debt reduction is currently creating a massive, coiled spring.
All right, we've reviewed the raw data, and it's time for the iron financial verdict. We've looked deeply at the Q1 actuals, confirming the $1.17 adjusted EPS beat. We've stress-tested the physical operations, seeing the incredible 106% utilization rates and the phenomenally low $17.30 US per barrel operating cost. We've tracked their balance sheet health, watching the debt systematically drop below $16 billion, which directly triggered the 75% free cash flow payout back to the shareholders. So, Lead Analyst, I'm going to ask you directly, measured against the current market weakness, is CNQ an opportunity to build real wealth, or is it just another value trap?
I don't rely on gut feelings or opinions for the final verdict. I rely strictly on the rigid mathematical structure of the business itself. Let's look exactly at what the Chief Financial Officer has to say about their current operating reality.
CFO Victor Darrell put it very bluntly, stating on the record, robust commodity prices in recent months, combined with our effective and efficient operations, are delivering strong netbacks, which accelerates debt reduction. My verdict is incredibly simple. This balance sheet is a fully fortified asset. There are absolutely no visible cracks in its armor. They aren't just surviving current market volatility, they are mathematically engineered to completely exploit it. By keeping their physical operating costs at the absolute floor, every single dollar the global oil price rises drops straight down to their bottom line. That rapidly accelerates their debt payoff and automatically triggers massive automated returns of capital directly to you, the shareholder. This isn't a trap. It is an absolute masterclass in capital allocation and unbelievable structural durability. And that brings us to the final, absolutely critical question you need to ask yourself as you build and manage your own portfolio today. The company is currently acting on its blueprint, aggressively buying back shares and systematically paying down its debt month after month. Their next major targeted net debt level is exactly $13 billion. And remember, the ironclad blueprint we discussed earlier. The very moment that debt hits $13 billion, Canadian Natural Resources increases their returns to push 100% of their free cash flow directly back to the shareholders. The heavy machinery is moving fast. The only question left is, when they finally breach that massive threshold and completely open the floodgates on shareholder returns, are you actually positioned to capture it? Thanks for tuning in to Iron Financial. Keep aggressively stress testing your assumptions, and we will see you in the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.